Hey guys, thanks for joining me. My name is Skyler with Cedar Ridge Management. I'm really excited to talk to you today about the number one important wealth building habit, and that is keeping a personal financial statement and updating it monthly. I started doing this in 2011 and my net worth was depressing. It was awful. I was just learning, and I attribute so much of my success to this discipline here. I do really want to highlight, I attribute all of my success, and I want to give glory to God for really providing for me. He wants us to be good stewards of our money and the resources that he's blessed us with, and keeping a personal financial statement and updating it monthly is one way to be a great steward of what you've been blessed with and to multiply it. So let's just dive into why this is important. So the first reason is that keeping a personal financial statement gives you accurate knowledge of your financial situation. Second, every single time you fill this out, you're going to increase your financial IQ, and you're going to understand, are the actions you took that month, are they helping or hurting your finances? And then three, this will make you a better real estate investor. I promise. Real estate investing is managing money and understanding how to make intelligent financial decisions. By doing this every month, you're going to see the relationship between different investments and how they impact your wealth, your cash flow, and ultimately your financial freedom. So before we go in, I want to give a shout out to these books. So the first one is Rich Dad, Poor Dad by Robert Kiyosaki. It is a phenomenal book. I highly recommend you go and read it if you haven't, or listen to it on Audible. The second is The Millionaire Next Door. Again, this is a phenomenal book about wealth building and real skills and disciplines that you need to have in order to create wealth for you and for your family. The third is The Millionaire Mind. It's by the same author. It is a phenomenal book. It just builds upon the concepts of The Millionaire Next Door. The Millionaire Next Door talks about being a millionaire, and then The Millionaire Mind is interviews and talks about being a decamillionaire. Phenomenal book. And then last, Pillars of Wealth by David Green, a phenomenal book that combines a lot of the concepts from Rich Dad Poor Dad and The Millionaire Next Door and a couple other authors into one very comprehensive how to build wealth book. Highly recommend that you buy them and read them, or listen to them, or better yet, listen to them, buy them, and study them, because there's so much stuff. I've read all of these books multiple times. All right, so let's just dive in. There's an example of this personal financial statement in the bottom of this YouTube video. There's a template for you, and we're just gonna go through and I'm gonna show you how to fill this out so you can start doing this today. All right, so the personal financial statement, we'll just kind of do an overview here. So the top here is the income statement, right? So this is income and expenses, and it gives you we call it net monthly cash flow here because this is your personal life, but this is kind of like the net income or the profit of your life. And then down below, we have assets and liabilities, and this is a balance sheet, and this shows you your net worth. So we'll go into each one of these, and I'll talk about certain terms. And if you have questions, shoot me an email. This is really supposed to be a tool to help you out. And I don't want to make it too long and too boring, because sometimes this stuff can be kind of dry. In that Millionaire Next Door book, they talk about one of the key habits that millionaires have is working on their finances. Millionaires work on their finances, I think he says like 7 times more than the average person. So if you want to be wealthy, keep a statement, work on your finances, and improve your financial IQ, like Robert Kiyosaki talks about. So the top here, we have your earned income. And as you're filling the spreadsheet out, the yellow cells are designed for you to put things in, right? So you can just go in and change the number. And then the green cells have formulas in them, so don't touch the green cells. So you put your earned income in, you put your passive income in, and there's a property financial statement that we'll dive into in just a second. So that's your passive income. And then if you have any stocks, bonds, dividends, etc., you'd put that income here. It'll total it up to give you your total income here. And then put in your monthly expenses here. It'll total them up, and it'll give you a a monthly cash flow number for your life. Now I want to dive into some specific ratios and things that I want you guys to be thinking about. First, your savings rate, right here. All right, this is a formula that is going to take your monthly net cash flow and your total income and give you a ratio. And this is basically telling you how much money you're saving. And you want this number to be increasing every month. That means you're making wise choices to increase your savings rate. And your savings rate is the money that you will have to invest in the future. So extremely, extremely important. Just a quick wealth building tip. Every time money is deposited into my checking account or deposited into your checking account, transfer a percentage of that money into a tithing account, into a savings account, and into an investment account. And prioritize making those 3 transfers before you spend money on anything else. This is going to force you to have a higher savings rate than most people. And it is a imperative investing and just personal financial decision to build wealth and to be a good steward of everything. All right. The next ratio to talk about is your wealth ratio. So retirement or exiting the rat race, this is when your passive and portfolio income exceeds your living expenses. So start thinking about that number today and not in 40 years when you want to retire. So this ratio adds up your passive and portfolio income and then divides it by your total expenses. And when this number exceeds 100, you have retired. Essentially, you have exited the rat race, and your passive and portfolio income exceed your living expenses, which is the definition of retirement or financial freedom. Next, how much money do you pay in taxes? Taxes is going to be your number one expense in life. So track it and do things, and you'll see as you make decisions, investment decisions, job decisions, that they affect your tax rate and how much taxes you pay. And if you can figure out how to structure your life to pay the least amount of taxes, you're going to increase your savings rate and therefore be able to invest more now to build wealth and exit the rat race or retire. Another extremely important ratio to look at is how much money do you spend on housing? The national average that financial advisors say you should spend is 33% of your income should go towards housing or less. This is a huge opportunity right here to increase your savings rate if you can figure out how to get this number as small as possible. You've probably heard about house hacking. House hacking is a way to minimize your housing expense to help you maximize your savings rate. So I highly recommend tracking coffee spending and, lattes, etc. But $5 here, $3 there isn't going to have a huge impact on your savings rate. But if you have a $2,000 mortgage and you can have somebody live with you and they can pay you $1,000, that $1,000 to offset your living expense is going to drastically help your wealth building goals. Another number to look at is how much do you spend on doodads? And this is basically a ratio from down here, taking how much money do you spend on cars, boats, etc., and dividing it by the total assets that you have. Next is, what is your annual return on assets, right? This number should be increasing every single month. And Robert Kiyosaki says that a professional investor can make this number be 20% a year. And then the next number to look at is your wealth ratio. How wealthy are you? And this is your productive assets divided by your living expenses. And it's measured in months. So basically, if you took everything you had and you sold it, and then you took that net worth and divided it by how much money you spend a month, that's going to give you this number. And it's another way of looking at it is, how long could you live if you sold everything and quit working? All right, now diving into the balance sheet. So again, fill out the yellow things, let the green things do their formulas. So you'll put in here your bank accounts, your stocks if you have them, any bonds, any other kind of receivables, your real estate holdings, and you'll put in the equity of your real estate holdings, and that is auto-formulated from this property financial statement that we'll get into again in just a minute. If you have any businesses or anything else, you can put that here. It's going to give you an asset total right here. And then you're going to put in doodads. Now, you'll notice, I want to call out, there's real estate up here in assets, and this is productive real estate that is generating income for you. And then you have your home down here. It's still technically on the asset side of your balance sheet, but we're calling it out different for a couple reasons. One, it takes cash flow from you every single month, so we want to think about it differently. Robert Kiyosaki calls these things doodads. If they don't pay you, they're doodads. That's the number one reason. And then we'll talk more about assets for accreditation here in just a little bit. All right, so you have your doodads total here, and then you have two different asset setups here. So you have total assets per a banker. So if you go get a loan, your banker's gonna look at this number. He's gonna add up all of these assets to determine how many assets you have. If you are trying to qualify as an accredited investor for different investment offerings that aren't available to the public, you're going to look at this number. And this number is excluding all of your doodads. It's excluding your home. It's excluding any cars. And the reason for that is because the Federal Trade Commission has decided that you need a certain level of net worth excluding your home to qualify for certain investments that aren't available to most people, because they want to protect the financially ignorant from different things. Next, I have down here your total current assets, and this is basically any asset that you have that can be converted into cash within 1 year. So it just adds them up from the top. Moving over to liabilities, you're going to type them in. All credit card debt that you have, put here. Any car loans, put here. If you have any school loans, your home mortgage, put here. If you have any other loans, and then it's going to total them up. And down in the bottom corner here, we're going to have your net worth according to your banker or a mortgage lender. And then we're going to have your net worth for accreditation. Now, it's so important that you look at the difference between both of these, because this one right here is good to look at, but again, this isn't helping you achieve financial freedom. If you live in a really, really nice house, and even if you have a lot of equity in that house, if it's not paying you, then it's not helping you achieve your retirement goals, your financial freedom goals. If you look at your net worth for accreditation, and that's the number that you focus on, you're going to make financially better decisions that are going to help you retire earlier or exit the rat race earlier than if you don't. And I can't emphasize how important this number is over this number. Yeah, it's just hugely, hugely important. If you have any questions about any of this, please send me an email at skylar@cedarridgemanagement.com. All right, now I want to dive into the property financial statement. So this looks just like the other one, but it has some different things on here. So we have the P&L, or the income statement for your rental portfolio at the top, and then we have the balance sheet for your rental portfolio at the bottom. So this is built for 4 properties. If you have more, hit me up, or just add cells in here. You can right click and add rows. But you put your property address here, you put how much income you get in rent there, and then if you have any vacancy loss, you put that here, and then you get your effective gross income. Now you put your expenses down here. So put your property management expenses, repairs, those are the ones that I've auto-filled here, property taxes, insurance, etc. Add all of that stuff that's specific to your property or properties here. Then down in the financing costs, fill out your mortgage interest and your principal payment, and then that'll give you a monthly net cash flow number. Now, it's important to note that your operating income is different than your cash flow, or than your net income number, which is different than your cash flow number. And the reasons for all those are just because the financial world has decided this is how we do accounting, and it's just important to know these things. Robert Kiyosaki talks about increasing your financial IQ to increase your wealth, and this is a way to increase your financial IQ right here. So operating income is income minus expenses, operating expenses. And then net income is your operating income minus your financing costs. And then cash flow is your net income minus any principal payments. So you can see we have an operating income of $1,500. That is what this property or this portfolio would generate if there was no financing on it. And then we have net income, which has the interest expenses in it. And then we have total cash flow, which is everything excluded. So talking about a few ratios that I want you guys to track or that you should be thinking about every month. So one, vacancy. Track this over time so you can be a professional investor and say, my portfolio on average has a 5% vacancy, 3% vacancy, 7% vacancy. What's the number for you and your properties? I personally use 5% based on where I invest, and that's Eastern North Carolina. Next, you want to track maintenance as a percentage of rent. And it's really important to look at this monthly and track it annually and track it from year to year to year. You're building wealth for your entire life. So you want to look at this number over the entire horizon. If you buy a house brand new and rent it out, it's going to have a much different maintenance number for the first 5-10 years than it is going to have from years 10 to 20 or 20 to 30. And it's just important to be professional and educate yourself and look at these things so you know how your property is performing. And then you increase your financial IQ and your ability to analyze other rental properties over time, because you know that a property like this generally has this type of maintenance expense. I personally use 15% for my maintenance number because I've been tracking this since I bought my first rental property in 2011. Next, look at the expense ratio. If you guys have ever heard of the 50% rule in real estate investing, that is an expense ratio number. That's basically saying 50% of the property's income is going to be allocated to expenses, and then I have 50% of the remaining money to spend on debt service to see if the investment works out. So look at this number every single month and look at the ratios and use that to underwrite future investments for yourself. Next, I want you to look at your loan to value, and this is the loan amount divided by the market value times 100%. Mortgage lenders, and I'd say the financial world at large, says 70 to 75% is a safe loan to value number. You got to come up with what number is important for you. For me, I like 50%. I'm super conservative. I want to leverage things. I want to use debt, but I always want to survive any kind of downturn, and I want to sleep really well at night. And I do that at about a 50% loan to value ratio. All right, so now we'll go down and we'll look at the balance sheet down here. So first, you're going to fill out the assets. So rental operating account. So if you have cash in your savings account that you use for your rental property and like your personal savings account, you should separate those and have a savings account and checking account just for your rental property. And you're going to put those numbers here. So put in your operating account balance, put in your rental savings account balance. And just a side note, I learned the hard way. I used to have a different checking account for every single rental property. And that got very, very hard after about 3 rental properties to do the bookkeeping properly. So now I have one checking account for all of my rental properties that I personally own, and then one savings account for all of them. And I have a minimum balance requirement in my checking account, and then a minimum balance requirement in my savings account. And everything over those minimums, I have available to invest and to buy additional rental properties. So set it up like that. If you have bookkeeping questions, shoot me an email. All right, next, you put the fair market value of your rental property right here, and be conservative. If you want like a conservative, lazy way to do this, take the average of Zillow and Realtor.com and put that average in here, and that should give you a good enough number. All right, next, you're going to put your liabilities. So if you have a mortgage, put that mortgage here. If you have a HELOC on your rental portfolio, put that here. If you have a credit card for your portfolio, put that here. All right, so this is going to show you a couple things down here. It's going to show you your equity from your property, and this is literally just the value of your home, of your rental property, minus the mortgage you have against it. And then you're going to have your total equity for your real estate portfolio, and that is total assets and total liabilities, which is including the cash you have in your checking account and savings account. All right, I'm gonna jump back over here real quick because you'll notice this number, this net income number, $566, is coming from this net income number here, $566. And then the real estate value on your personal balance sheet is coming from the equity, the total equity from your real estate portfolio number over here. So it's really important to look at both of these and to separate them so you can see clearly how your rental portfolio is affecting your personal financial situation. And then for fun, I have these terms and definitions. So if you want to know what is a current asset, what is a current liability, these are all things that are extremely important to learn, to know, to use, and to make these words real in your life so you can become a better investor, more financially free, and hopefully glorify God with all of that. Really appreciate you guys. Again, there is a link to this document in the notes below in the YouTube description. And if you have any questions, hit me up at Skyler@cedarridgemgmt.com. God bless you guys and look forward to connecting soon. Take care.